Listen, I think that we are going to see a meaningful correction by the end of September. Now, I'm not predicting a 2008 style financial crisis. I'm not saying we're going back into the Great Depression. I'm just saying markets don't tend to move in a straight line, and everything is pretty stretched. And I would be surprised if we get through the end of the quarter without having some volatility associated with a resetting of expectations.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. The dollar has weakened considerably so far this year. And amidst the US administration's hardball trade tactics, critics claim that foreigners are ramping up their de-dollarization efforts, they're buying less US debt, and that the days of the dollar as the dominant world reserve currency are ending. Well, how much truth, if any, underlies this? For answers, we're fortunate to welcome back to the program Brent Johnson, CEO and Portfolio Manager at Santiago Capital, developer of the Dollar Milkshake Theory, and publisher of the Macro Alchemist. Brent, it's great to see you again. Thanks so much for joining us today.
Thanks for having me. Always fun to talk to you.
Always fun to talk with you, Brent. And a lot going on, especially in your area of expertise. So if you don't mind, let's just roll up our sleeves and jump right into it. Couple of big topics here for you, but just to get out of the way, why don't we just start with the dollar? It has weakened substantially this year. Showed a little bit of life recently, but now starting to potentially weaken again. From your perch, studying the dollar and all things Dollar Milkshake, what's your outlook on the dollar right now?
Well, I think it's pretty oversold right now, and perhaps unnecessarily so. Now, I'll couch this and say it doesn't mean that the dollar can't go lower, and it doesn't mean that it has to rocket higher. But what I would say is the table is set for a rally that few expect, and it's these unexpected dollar rallies that tend to cause problems in global financial markets. The dollar falling is typically not a huge issue for global markets because the dollar falling kind of perpetuates the status quo and perpetuates the system as it is. The dollar falling indicates that there's plenty of global liquidity. It indicates that credit is being extended and that there is probably at least some level of expansion going on. And the reason is because the dollar underlies the entire global economy. So it's when the dollar starts to rise and credit starts to contract rather than expand that problems tend to happen. As a manager of assets, if the dollar is going down, in general, that typically means asset prices are rising. Not always, but in general, that's what that means. And so as someone who oversees assets, the dollar falling is not something that worries me significantly. We're prepared for the dollar to go lower. What we hedge against and what we're always on the lookout for is these unexpected moves higher in the dollar. And I think that, again, the table is set for that. Whether it happens or not, we'll see. I am expecting some volatility over the next couple of months, and perhaps significant volatility over the next couple of months. And again, that typically coincides with a rising dollar, not a falling dollar.
Okay. And is that volatility expectation more due technically to your fact that you just think it's very oversold here and ready for a bounce, or are there more sort of structural, fundamental, geopolitical factors that you're expecting to create that volatility?
Well, I think it's all of the above, all of the above. And I want to make sure I don't come across as totally hyperbolic here. All I'm saying is the table is set for some great volatility. And if that great volatility does show up, asset prices do not reflect people being prepared for it. And my job is to always be prepared for these unexpected bursts of volatility. And the signals that I look at are telling me now that, again, the table is set for one. And there's a number of different catalysts. I could probably name 5 different potential catalysts that could cause some unexpected volatility. And when everybody's on the same side of the boat and everybody's positioned the same and everybody is greedy and nobody is fearful, that's typically when these things happen. And for whatever reason, Adam, I don't know why this is. Historically, these things always tend to happen in the fall.
Yeah. Yeah. Okay. Well, so if you don't mind, let me just scratch a little bit. So you said, signals you're looking at suggest the table's set and that you could list off a couple of potential catalysts. Can you give me just a couple of signals that you're monitoring?
Sure. So you look at the breadth of the market, meaning how many stocks are making all-time highs, how many stocks are contributing to the overall market cap. And the market right now has really never been more concentrated in the top, let's call it 5 to 10 names than it is right now. And then again, and that's from a market cap perspective. If you look at the contribution towards earnings or the contribution towards income, again, it's all concentrated in these 5 or 10 names. The broad market is not participating in this growth. And the effects of passive management, and I know you've spoken to Mike Green several times. He's kind of done a lot of work explaining the effects of passive management in contributing to the winners continuing to win and the losers continuing to lose. And we're just getting to a very extreme level. And the last 2 times we've gotten to these 2 levels, which is most notably February of this year, January or February of this year, and then last June and July, within about 6 weeks of those 2 periods happening, we experienced fairly high volatility on both occasions. Now, what's really interesting for me is I've been doing this for 25 years now. And a year ago in early July, I had never seen all of the indicators that I follow all flash red at the same time. And I remember thinking I could probably go another 25 years and never see this again. Well, it happened again 6 months later, and now it's happened again 4 months later. So in the last, let's just call it 13 months, I've seen something that I hadn't seen in the previous 24 years. Now, I'll stress again, this is no guarantee that we're going to have a crash. And I'm not really predicting a crash. I just think we're overdue for a correction. And I think because not everybody, but the positioning, the sentiment, the extreme greed, the lack of fear, the VIX is sitting at 14. And when I look at the reasons why we've had this incredible rally out of the depths of April, I feel like a lot of those reasons no longer exist. And yet the market remains at these highs. And so I think we are due for a correction. Listen, I think that we are going to see a meaningful correction by the end of September. Now, I'm not predicting a 2008 style financial crisis. I'm not saying we're going back into the Great Depression. I'm just saying markets don't tend to move in a straight line, and everything is pretty stretched. And I would be surprised if we get through the end of the quarter without having some volatility associated with a resetting of expectations.
Okay, that's pretty declarative. So I appreciate you being as declarative as you can be here. So let me ask you this. You said earlier you could list, some potential catalysts. So we don't know what's going to cause this correction, but if it does indeed happen, what do you think the likely culprits may be when we look back at this?
Well, first of all, I think the reason for the sell-off in April was the uncertainty surrounding tariffs and the impact of tariffs. Now, the uncertainty's kind of gone, and but the tariffs are just now hitting. So in other words, we had a huge rally coming out of April because the tariffs were kicked down the road. Many people thought they were just completely eliminated, and that when it came time for them to come back, they wouldn't even exist at all. Or if they did exist, they would exist in a very muted form. Well, the reality is they're back. They've just been put in place about a week ago, and they're higher than many people expected. So that's one. The other is that we're getting to a point where the Fed may make a pivot. Now, the interesting thing is I think a lot of the reason the market has rallied is the expectation for a Fed pivot. So in some ways, that is already priced in. And somewhat associated with that is that while inflation is no longer surging the way it was, 18 months ago, it is also not crashing, right? And so I think while Powell may cut rates, I'm actually not expecting him to, but while I admit that he may do it, if he cuts rates, I don't think he will be cutting rates because things are fantastic. My guess is he would have to be cutting rates because he sees something bad or the potential for something bad. And I think it's possible if the good stuff is already priced in, and then he starts cutting, even though inflation is not dropping dramatically, then why is he cutting if inflation is not dropping dramatically, right? And so I think that has again, and I don't know, I'm saying that has the potential to unsettle markets.
Yeah, and
And then
sorry to
somewhat
interject here,
associated, go ahead.
I was just talking about this earlier today with Stephanie Pomboy. Um, the historical pattern is that when the Fed starts cutting interest rates is generally when their next recession shows up.
Well, that's exactly right. And I guess that's my point, right? The tariffs, I kind of sent out a tweet yesterday. Really, I don't really have a strong opinion on it, but it was more just to get people to think. And that is, inflation, again, it came in somewhat soft, but not dramatically soft, right? It was still it was at 2.7 versus 2.8 expectations. And
Yeah. And
so
core was
while
higher
it's
than people thought. So yeah.
right, and earnings have been high. And so I guess the point is if tariffs are supposed to be inflationary and it's not showing up in the data yet, and arguably it's not showing up yet because they've really just come into place, a couple of weeks ago. But I guess my point is even with the expectations of tariffs, we're not seeing dramatic inflation. So if tariffs are supposed to be inflationary and they're not, what does that tell you about the underlying economy? Right? And so if they're cutting, even though inflation is not dropping or rising, what is it that's making them cut? My guess is they would see some potential for some contraction, and they're trying to offset that. Well, is contraction great for markets that are all-time highs? Probably not. Now, again, I am not in the camp that we're going back into 2008. I'm not in the camp that we're going into the Great Depression. And I'm really not even in the camp that we're going into a significant recession. I just think we're overdue for a resetting of expectations. And I think the table is set in a way that lends that to happening, in the fairly near future, not 6 months from now.
Okay. So then why don't I get to the heart of this then? I usually wait to get here, but I'll pull it up early in this conversation. So given that, how are you positioning for this table setting?
Well, I'll answer the question, but I'll set it up with what I've done year to date, because I think this is a little telling. And at the end of last year, I was saying that 2022 was my analog for 2025.
I remember that.
And that while I thought the first 6 to 9 months would be very volatile, I was actually somewhat cautiously optimistic for the second half or the end of the year and into 2026. I think I mentioned this when I was on your program in March.
You did.
But part of the reason I was using 2022 as my analog was because 2022 was a regime change as far as interest rates. For the first time in many people's lives, we were on a big interest rate hiking cycle, and nobody was quite sure how to deal with that. And I thought this year we're moving into a period of time where the U.S. does business differently than they've done business with the world for decades, and that is the tariffs. And that's a regime change. And I thought it would take a while for people to get their arms around that and understand that. And so I was expecting great volatility. Now we got that. And so I was expecting great volatility in the first part of the year. We got that. I was expecting, now I thought it actually got a little too oversold in April. I thought there was a bit of an overreaction to the tariffs. So I was very much expecting a rebound, which we had. And I was very much expecting the rebound into May and even early June did not surprise me. So we had a lot of hedges on in the early part of the year. Those paid off magnificently in April. We pulled most of those, almost all of them, in April, and we kind of rode the wave higher. We started putting those back on kind of late May, but really kind of early June. And so, like I said, I don't think I could have been much more right for the first 5 to 6 months, but I don't think I could have really been much more wrong the last 2 months since early June, because I was expecting that we would start to roll over again. Now, again, I wasn't expecting a crash, but I was expecting things to roll over. But instead, things have just continued to grind higher. And I saw that, and that's the interesting thing for me is that's the same thing that happened a year ago. A year ago in 2024, we started adding some pretty significant hedges in June, and the market continued up into the middle of July. So we were early, but ultimately we weren't wrong. The same thing happened to me at the end of last year. We started adding some hedges pretty in kind of December timeframe. We started adding to them pretty significantly in January and February. Initially, we were wrong, but it ended up being right. And so a lot of times on these things, I tend to be early, but I tend to not be totally wrong on it too often.
Yeah.
And so I thought that we would have a rollover earlier from the rebound this summer, but I feel like we're just kind of getting to that now. And I'll tell you why. The last 2 or 3 weeks, I guess we've started to have earnings, right? And earnings have, in general, been pretty good. But there's been a couple things that have been significant to me is that while earnings have been pretty good and markets have kind of made new highs, they haven't rocketed higher. They've just kind of been grinding higher. The other thing is that while the S&P has kind of come back to its high, and while the NASDAQ has exceeded its high, the Dow has not. So again, there's some divergence between which markets are making new highs and which ones aren't. The ones that are making new highs are characterized by the FANG and the Magnificent Seven and the top 10 tech stocks. The ones that are not, that's more kind of indicative of the overall economy, is not making a new high. The other thing is in April, when Microsoft released earnings, it gapped higher. And then for the next 3 months, if you look at a chart of Microsoft from April to July, it is literally a stair step higher almost every day. I don't know if I've ever seen a chart like that in my life. Then they had earnings again a few weeks ago at the end of July. Again, fantastic earnings. Gapped higher the next day, but instead of stair stepping higher the way it did in April, it's been stair stepping lower since. So I guess my point is I feel like we've kind of, I don't know that we've hit a ceiling, but we've hit a level that I feel like it's hard to continue running through with the same momentum. It's kind of like if you're riding a bike up a hill. As long as you continue pedaling and you've got the speed with you, it's easier to keep going higher. But if you stop and take a drink of water or something, and then you try to go again while you're still climbing, it's really hard to climb that hill. And I just kind of, my signals are telling me that's kind of where we're at. And just my historical experience is telling me that's where we're at. And when I look at momentum indicators, we now have divergence between price and momentum. Whereas for most of Q2 and into early Q3, momentum and price were both rising. Now you have price rising, but momentum has already rolled over. That typically, not always, but that typically is an indicator that price is going to follow.
Okay. So very helpful context. So back to the question. So how are you positioning for what changes have you been making to your portfolio? I mean, I guess you've been putting hedges on, which...
Well, so also we've started to add, I mean, our hedges have basically not paid off for the last 2 months. So that's been pretty frustrating. I'm the first to admit that nobody likes to pay money that goes to waste. But at the same time,
sorry to interrupt, but just to give you some air cover there, right? Hedges only have value if you get them in place before the event happens, right? So to a certain extent, you're always going to be early with a hedge. Yeah.
Well, and that's the other thing. It's important for people to know the way we manage money. Like we always have some type of, like even in a good environment, we always either have some cash on the sidelines, some type of light hedge on positions, and we always have tail risk hedges, always. So we are never just 100% long, leveraged long. That's just not the way that we manage money. Now, we started adding them back, again, like I said, in early June. And a lot of those have now, either expired worthless or are going to expire worthless. But we are adding back to those positions because all of the indicators are telling me that now is the time to do it. And here's the thing. With the VIX at 14 or 15, whatever number, you are just probably not going to be able to buy insurance much cheaper than that. It's not impossible. Of course, anything's possible. Would it completely shock me if the VIX goes to 12? It wouldn't shock me, but I just know from experience that if you're going to be adding insurance, you're better to do it when the VIX is at 14 than when it's at 44.
Yep. Okay, so sorry I interrupted. I think your stream there,
No, no.
but so you've added hedges. So a lot of them are expiring, but you're re-upping them. Have you
Yep.
shifted your other portfolio allocations, or are you
Nope.
just protecting with hedges so far?
We're just protecting at this point. I mean, here's the thing. Everything is at its all-time high. Real estate's at its all-time high. Gold's at its all-time high or within $100 of its all-time high. Um,
Bitcoin.
Equities at its all-time high. Bitcoin's at its all-time high. I don't like buying anything at the all-time high. Again, now I'm not saying that everybody needs to go out and sell everything. We still own all of these assets, but we are very much expecting and prepared for a correction. Now, if the correction doesn't happen, are we going to get totally wrecked? No. Is it going to hurt? Of course it's going to hurt. But we're set up in a way that if assets go up and to the right, we are going to participate. And we're always set up in a way that if there's a massive drawdown, we are not going to experience all of it. And we're probably only going to experience a little bit of it. And what we have found is over time, if you catch most of the upside, even if you don't catch all of it, but you missed most of the downside, even if you experience a little bit of it, over time, you tend to do pretty well.
Yep.
And because most of our clients are either in retirement or moving towards retirement, that's our mandate. Now, if you have a mandate to beat the S&P 500 or the NASDAQ or something, then you have to structure your portfolios completely differently. But for the types of clients that I manage money for, our goal is preservation of capital, get a fair return. And if we can make some upside on top of that, then that's just gravy.
Great. Okay. So just to make sure I understand correctly, you are primarily being defensive through these hedges. It sounds like you haven't done much portfolio trimming at this point, but is that something as you got more concerned, would you start doing that?
Well, the thing is most of my clients I have had for years. And so we've owned these positions for years, whether it's gold, whether it's stocks, whether it's their real estate, and most of the stuff, if you go back and look at the charts of all these asset classes, they're all up and to the right, right?
Yep.
And so if you start selling actual positions, you start incurring some fairly high taxes. And a lot of my clients live in high tax jurisdictions. So, selling is not always preferable. But my guess is that as of right now, we have hedges and maybe we would benefit a little bit if things went down. In other words, we wouldn't just protect if things went down. We would actually make money if things went down.
Yep.
If things get much more extended than they already are, it wouldn't surprise me if we add to these defensive positions even more and try to profit from the downturn. Remember, a lot of the times, most of the time, we're not trying to profit from the drawdowns. We're trying to protect the drawdowns. And that's a much different way to position your portfolio than if you're just trying to protect. And so we have not shifted our allocations. I will say, and this may surprise people because I'm talking about being bearish in the short term. I will say that I would expect sometime in the next 3 months that we will increase our exposure to U.S. equities. So, I haven't done it yet because, again, I think they're overextended. But
is that because you're assuming a correction?
Yeah, we're assuming a correction, and we're assuming that the United States economy will continue to outperform the rest of the world. Now, I think I need to make it clear when I say outperform, that doesn't necessarily mean perform fantastically. It just means perform better than its peers.
Yeah. Just the old joke about the two hikers that encounter the bear.
That's exactly right.
You don't have to run faster than the bear. You just have to run faster than the other hiker. Yeah.
That's exactly right.
Yeah. Okay. Well, let's talk about that kind of relative performance there. So you were making some posts on X recently, talking about the veil of altruism. And I didn't follow the discussion fully, but I'll tell you what I took from it, and you clarify if I didn't get the right gist of it. But I've had enough conversations with you, Brent, to know that you think, hey, look, the people that are touting the demise of the U.S. are really undercounting the U.S.'s the strength of its position, and that if the U.S. like really wanted to represent its interests, it not only has a lot of good options still on the table, but it has a lot of dirty options still on the table, dirty tricks that it hasn't played yet. And so, if the U.S. was really motivated to really look out for itself, that it could exert much more force right now in the global sphere than it currently is. And so I take your veil of altruism, which is the US has kind of put itself out there as the world's policeman and peacemaker, and we're going to subsidize a lot of good things we want to see in the world, and America plays a very important role, and I think Americans are proud of that. But you're basically saying, look, if America really got threatened or pinched and it dropped that veil of altruism and just adopted a face of pure self-interest, it could do an awful lot more than people are giving it credit for. Am I taking kind of the underlying message you had there correctly?
That's exactly right. And this has kind of been a key part of my, whole dollar milkshake theory. And that is that I think the veil of altruism is just kind of a term I coined because, I think it goes, when I was a kid, I can literally remember Ronald Reagan saying, America is the great shining city on a hill. And that was what, much of the world aspired to. And to me, that's the veil of altruism, right? And it's not to say there wasn't altruistic meaning there. But my point has always been that if that no longer is possible, or if that is no longer wanted, there's a lot of things that the United States can do wearing the black hat as opposed to the white hat that I don't think many people are prepared for. Now, perhaps the United States historical enemies, if you want to call them that, are ready for that. But I don't know that France was ready for it. I don't know that Australia and Canada were ready for it, right? Mm-hmm. And I think this is kind of what we're seeing now. I think we're at a point in history where the veil of altruism is being removed. And I would classify the veil of altruism as the same thing as the rules-based order. Now, the rules-based order, it sounds like a silly term, but it's actually a real thing. Like post-World War II, the United States and its allies set up a system of global governance that basically set out the rules for how things would happen on the global stage. Now, I've written a little bit about this on our Substack, and I've talked about it a lot in different presentations that I've given. But the reason it's called rules is because it's also a form of control, right? Now, when it was initially put in place, it was unveiled as, we are going to do this for the greater good. We are going to do this to promote peace and harmony and global efficiency and global development. And we were going to do this so that it takes off the table of ever having another conflict such as World War I and World War II. And this is going to be done for the the greater good of the global community. And I think there's absolute truth in that. That's the altruistic version. But when you look at the term rules-based order, rules are a form of control. And that is what it has, while it has been all of the altruistic things, it has also been a form of control. But it has been a form of control for the greater good, not strictly a form of control for the United States. And it's been my belief, and actually it's been my fear as well. I shouldn't just say it's been my belief. It's been my fear that before this is all said and done, the United States will take off the white hat. They'll take off that veil of altruism, and they'll just put on the black hat, and they'll say, this is the way things are going to be, whether you like it or not. It's like that scene in Star Wars where Darth Vader says to Lando Calrissian, I'm changing the deal. Pray I don't change it any further.
Right.
I don't necessarily like this. I don't necessarily like it. I'd prefer it wasn't this way. But I have to deal with reality. And that's where I think things are headed. And I think you can very clearly see that with the Trump administration. He has very clearly not only said, but put people in his cabinet who tend to agree with him that the rules-based order no longer benefits the United States in the way that it once did, and that we are now moving towards a system of America first, not for the greater good. If the greater good coincides with America first, that's fantastic. But if it's not, then the greater good is just going to have to take a second seat, because we are now doing things for the good of America. And to me, this is as clear as you can get. And while I think a lot of times people will say, mainly because they just don't like the guy, which again is understandable, that everything that Trump does is kind of just off the cuff and there's no plan and he doesn't know what he's doing. And I think that's completely wrong. I think there is a plan. I think there's a method to the madness. And I think if you understand what he's trying to do, it's not even that particularly clever. And I don't think he's trying to be clever. I think it's just pure power politics. And, you and I have had this conversation many times before too. I think the separation between power and money is like about that big, right?
Yeah.
The two go hand in hand. And so this belief that the U.S. would act this way if and when necessary has always been a part of my belief that the U.S. would outperform the rest of the world as we kind of go through whatever it is we're going through. That was kind of a long-winded answer, but that...
No. So it was great. So the critic would say, well, America is shooting itself in the foot here, and Trump is railroading over old alliances, and foreigners are going to stop buying our debt, and they're going to create trading blocks like the BRICS, and the dollar is going to lose its place as the world reserve currency, and all that stuff, right? And you and I have talked enough about this, Brett. I think I know where your mind is, but at the end of the day, it is really all about power. And I guess you could say with the current administration, Trump specifically, is his position is, hey, the U.S. hasn't been using all the tools of power to its advantage that it has, and I'm going to try to, I think they're underutilized. I'm going to use them correctly for America's interests here, right? And if that makes me a black hat or a gray hat, I don't care, because I'm America first, right? So he's betting that he's got the power to bend the rest of the world to America's plan here. Now, the critics might doubt that. Where do you fall on this? I think I know, but I'll let you answer.
Well, to me, I probably don't disagree with the critics in the fullness of time. But you could argue that since 9/11 and the way the United States responded to the rest of the world post 9/11, that all of the criticisms that that people are giving to the United States now have been making them for 25 years.
Mm-hmm.
And it's not that they're wrong, but here we are 25 years later, and the United States is still the global superpower.
Right. And
so,
the highest percentage of world capital is in the U.S. market than it's ever been.
Exactly. So it's not that I think that none of these actions will not have unintended consequences. Of course, there will be unintended consequences. And I think in the fullness of time, this period of time will probably be looked at as maybe the period of the time when things started to go wrong, so to speak. But the one thing I've learned, and again, having done this for 25 years now, even if you have an idea or you think how things are going to play out, it often takes a lot longer to fully play out than you think it will, especially things on the global stage or in the macroeconomic world. And I think people don't have part of the reason that I think people struggle with this is that for much of my life, actually for most of my lifetime, and probably most of many people still operating, in the markets today, their lifetime, the world was for the most part at peace. Now, of course, there was always these little regional things going on, and I'm sure there's some places in the Middle East or Asia that or even South America that saw some war, and they will say, well, we didn't have peace. But on the global stage, for the most part, we have, Pax Americana has held. And so I think during that time, people like me, analysts in the Western world, were able to look at markets and investments and potential financial opportunities strictly by the numbers, based on, do they pencil out on a spreadsheet? This is the cost of capital. You don't have to worry about political revolution. You don't necessarily have to worry about a geopolitical event that's going to, disrupt it. But I actually think those days are gone. I think now when you're looking at opportunities, I think you very much have to consider the politics of it. I think you very much have to consider national interests. I think you have to very much consider alliances and whether those alliances are strong or whether those alliances are weak. And I think you have to just be really ruthlessly, brutally objective on who holds the power and who doesn't. And I think when I do that critical analysis, regardless of whether I like it or not, I think the US comes out on top. Now, that's not to say that China doesn't have power. It's not to say that Russia doesn't have power and Brazil doesn't, all of the BRICS. Of course they have power. But I think the US still has the most power. And I think they are now using it. And because people didn't have to think about power dynamics for most of their career, now that they have to think about it, rather than just dealing with it as it is, they try to push back against it and say, well, it shouldn't be this way. I don't like this. This is immoral. This is going to lead to bad things. And while all of that may be true, I don't think it's going to help you analyze current investment opportunities. And so I think there's a mental part of all this that people are struggling with. And perhaps rightly so. And perhaps this is all part of these, fourth turning dynamics that we've talked about several times. But so we have all of these conflicting events happening. We have financial conflicting events. We have geopolitical conflicting events. We have mental conflicting events, and it's all kind of bundled together. Whereas you used to be able to analyze domestic politics, in a silo, and geopolitics in a silo, and markets in a silo. To me, it's all one thing now. There's no longer a distinction between the three.
Oh, well, super well said. You're making me think what I'd love to do at some point later this year, Brent, is get our good friend Michael Every on with you and just do, kind of a code deep dive into power dynamics, because that's, the lens that Michael looks through in a way that's
I will
educated both you
say
and I.
for anybody who has heard me talk but has not heard Michael talk, then you absolutely need to talk to Michael. It's funny because I was talking about these things for a long time, and Michael was talking about these things for a long time, and we kind of talked about them in different ways. But when we started talking to each other, we realized that we basically saw the world the exact same way. He's much more, I don't know, I would say sophisticated in his language, the way he explains them. And
Well,
he's
he's
much more,
British.
and he's much more eloquent in the way that he writes about them. But I don't know that there's anybody in the world that I agree with more of regarding the current situation that we are in than Michael.
So, folks, if you haven't watched my previous interviews with Michael, go back and look at them. They'll be really helpful in sort of setting the stage for what Brent and I are talking about here. Brent, I got to say, it was a real treat to be there when you and Michael met in person for the first time.
Yeah.
That was really fun. It's also me meeting each of you in person for the first time
Yeah.
too. But that was a fun, special moment. It's great to see how that relationship between the two of you has blossomed since. But yeah, anyways, folks, if you like that idea of getting Brent and Michael on at some point, I'll try to make that happen at some point in 2025 or early 2026. All right, so Brent, so Trump, I think rightly or wrongly, I think he is unafraid to wield power, and we're seeing that in all sorts of different areas. We're seeing it in geopolitical trade. We're seeing international trade. We're seeing it domestically. He's not afraid to send the National Guard to LA or to take over Washington, D.C., right? He's just like, look, I got the power. I'm going to use it, right? So let me ask you this. So, he's done a pretty aggressive job of pushing through the policies that he wanted to see very early on in his presidency here. And so I want to ask you a question I just asked Stephanie Pomboy, which is, you can look at the macro data economically and see, the economy is slowing, right? Not necessarily hurtling towards contraction, but it's slowing. The labor market is cooling, right? And so, you can make arguments that, we may have some tougher times economically going forward in the near term. Now, the administration would say, hey, the cavalry is on its way, everybody. We're bringing all this investment into the US. We have struck these better trade deals. We got hundreds of billions of tariff revenues coming in now. We're passing through all these deregulations. We're changing the tax code. So as you look at all this, Brent, timing wise, what do you see in terms of an overlap or a gap between a slowing economy and an economic boost from the policies that have been enacted? Can the cavalry arrive in time, I guess is the question.
So it's a very good question, and it actually relates completely with what I was talking about, expectation for great volatility over the next couple of months, but not being in the Great Depression camp, right? Or not being in the 2008 camp.
Right. And wanting to buy into equities if
And
better
wanting to buy,
valuations come
because
along.
so I'm going to answer this, but I'm going to tell everybody ahead of time. When I talk about good in this situation, I don't necessarily mean good from a political or social standpoint. I'm just going to talk about economics, right? And so I think we could potentially have a big bookend with regard to the United States. Now, what do I mean by that? So going back to Trump's power policies, for all of the things in the world that he does not understand, and there are innumerable, I think he does very much understand power, and I think he very much understands leverage, and I think he very much understands the media and the power of a narrative.
Mm-hmm.
So whatever else you think about him, I think that I think he knows, not only is an expert on those things, I think he knows how to use them. And one of the ways he's going to use that, I think, is with the Fed. And you're already seeing it, right? And this is one of the potential catalysts that I was talking about earlier. I didn't mention this particular one, but one of the potential catalysts that could play out in the next, call it 6 to 8 weeks, is a battle, the ongoing battle or the continuing battle between the president/Treasury and the Federal Reserve. If there is a correction, Trump can very easily lay it at the feet of the Fed. Regardless of whether it's true or not, I think he knows how to do it and will be successful in doing it.
He's already set the stage. It's too late.
He's already set the stage for it, right? So, or perhaps this continual battle between the Treasury and the Fed is the catalyst that causes the downturn. Again, I don't know. I'm just saying, again, the table is set for some kind of an unknown catalyst or an unexpected catalyst to cause some downside. But regardless of which causes what or who says what, if there is a downturn, that will be the opportunity for Trump to gain even more power. I mean, how many times have we heard, extreme circumstances or emergency powers or whatever it is, right? But if there is a hard sell-off, and again, I don't know, but if there's a hard sell-off, that will allow Trump to say, see, the Fed is out of control. They're not paying attention. They haven't done a good job. They caused all this inflation, and now they're behind the curve again. They're spending $2.5 billion on a palace that they don't need. All of these things, right? And believe me, that will sell. In a bar in Omaha, that will sell, even if it doesn't carry weight on the canyons of Wall Street or in, the K Street in Washington, D.C. It will sell to the general public. And so while that could cause great volatility early on, and while it could cause great volatility a couple years down the road, if the Treasury gets more control over monetary policy at some point in the next couple months or even a year, and then they can combine that with the fiscal spending of the U.S. government, you could see a boom in stock prices. Even if interest rates aren't dropped dramatically, or even if they are dropped but are still higher than the rest of the world, you will get, in my opinion, a further playing of the imperial circle. Now, if you're not familiar with the imperial circle, I think the imperial circle is why the markets have done so well over the last couple of years. So the imperial circle is a concept that was popularized by George Soros and Druckenmiller back in the 80s or 90s, I guess it was. And I believe it started when Germany reunified East Germany and West Germany. There was a belief that the economy would struggle. And part of it was because interest rates were high because of the uncertainty associated with it. But what Soros and Druckenmiller said was, no, if you've got high interest rates, that will make that currency more attractive on a relative basis. And then if you have the government spending a lot of money, which Germany was going to be spending a ton of money on the reunification process, they said that can actually lead to a boom. And I would argue that's exactly what we've seen the last couple of years in the United States. And that was a seminal part of the whole dollar milkshake theory when I first started talking about it, is that the relative higher rates in the US would attract money into the dollar. And then the fiscal spending that accompanied with it by the government could push asset prices higher. Now, I think we need a correction. I think we need a resetting of expectations. But if we get that, and Trump gets more power, and Bessent gets more influence over the Fed in whether they install their own guy or girl, or whether they actually roll it up into the treasury, who knows how they actually do it. But my point is I can envision a scenario where we've seen what we've seen the last couple of years continues for another couple of years. And I know there's a lot of people saying there's no way this can continue. That's fine. You probably said the same thing in April. You probably said the same thing in 2020, and you probably said the same thing in 2008. And perhaps you're right. Maybe it won't continue. I'm just saying I can envision a scenario where that happens. And so that is why I think while in the shortness of time and in the fullness of time, all of this power politics may be a detriment, in the middle, I can see it being a benefit.
Okay. All right. I want to move on to one last topic, but real quick, just to wrap this one up. How much of, if any, of your enthusiasm for buying into the equities in a couple of months, if there indeed is a correction, how much of that appetite is driven by an expectation of an accelerated economic growth from the new policies that have been enacted?
I thought that's a good question. On a percentage basis, I don't know, but I will say that for all of the drama surrounding the tariffs and Trump's policies, I'm not going to sit here and say that I think they will work perfectly. And I'm not necessarily in favor of tariffs, but it doesn't really matter what I want or what I think, right? What matters is what's actually going to happen. And the reality is tariffs are here. And the reality is the government's going to keep spending money. And I think that the rest of the world will continue to do business with the United States, even though they might not like us as much as they used to. And I think the policies that Trump is putting in place and that his administration is putting in place could actually lead to economic expansion. I think it will work better than many are expecting to work. Now, whether it works good, that's, I'll just have to wait and see. But I think it has the potential to work better than many people think it will. And one thing I would say is there are so many people who will argue that China has been outmaneuvering and outplaying the United States over the last 10 or 15 years, and that they continue to do so. Well, we are just now starting to do some of the things that China's been doing forever regarding tariffs and stimulus and, favored industries. So if China has been outperforming us, and it's, how come these things that you don't want the United States to do haven't hurt China? And so to me, there's a big dose of hypocrisy for those who think that none of these policies can work. They might not work the way we want them to be, and they might not work perfectly, but to say they won't work, I think is just wrong. Because for literally most of history, tariffs or some kinds of mercantilist policies were the norm. Again, it's really only in the last 50, 60 years where laissez-faire, free market dynamics, a lack of, tariffs. That's that's when that kind of really happened. But that's not normal. That's the exception. I think most people are thinking these tariffs are the exception, but it's not. Like these mercantilist policies, these are the norm. We're just going back to the norm. It's the last 50 years that have been the historical exception.
Mm-hmm.
And so to say it won't work, I think, is to ignore much of history. Now, again, it doesn't necessarily mean we're going back to Camelot and, sunshine and rainbows. But I think you have to kind of set your expectations. But again, it's a relative. I always tell, you've heard me say this a million times, it's a relative game. And when I look at a global map, I don't know where else I would want to set capital for the next 3, 4, 5 years, if not the United States.
Okay, thanks for intuiting that question too. I like to ask you that every time, and you already just answered it. So if you're playing risk, you're picking the U.S. As your starting point. Okay, so we probably don't have enough time to do this last topic full justice, but that's okay because before we turned on the camera here, you agreed to let me use one of your most recent articles on this topic as an upcoming macro pass for my premium Substack subscribers. But I want to trundle over to the housing market with you for a moment because Brent, it's something I talk about on this channel a fair amount. And periodically you will do a deep dive on it, and you just did another one. So why don't I let you, because it's a broad topic, why don't I let you just sort of, whatever you think is most important for folks to understand about your current outlook on housing?
Sure. So the first thing I'll say is we just wrote a report focused on US housing. Now, this was a follow-up to our inaugural report from a year ago, which was on global housing. And the thesis of our inaugural report a year ago was that global housing has become very much enmeshed with each other. It was no longer separate markets, and that problems in one housing market could have reverberating effects on the United States market. Now, this report, it focuses just on the United States. And what we have found, again, this is not a prediction, and I think the report will probably come across as perhaps a little bit more bearish than I will say here. And again, when we write these big reports, they're really kind of think pieces. It's us putting down our thoughts on paper on the things that concern us, the things that we're thinking about, and we believe that could become a big issue. They're not necessarily predictions so much as they are thought experiments. But what we found is that, and this is not necessarily new, but when we analyzed it, it had a number of corollaries which we had not thought of before. And that is, there's a huge amount of people in the United States who have locked in their 30-year mortgage or even an armed mortgage at historically low interest rates. And while that is probably seemed like a genius idea at the time, and it's not necessarily a bad idea now, what it has led to is an immobility and a freezing up to a certain extent of the market. And what we mean by that is, if you bought a house 4, 5, 6 years, 10 years ago, and you had it and you refinanced it at a historically low mortgage, if you want to trade up to a bigger house, it's really hard to do it, because to sell the current house and go buy another one, you're going to have to refinance. Instead of being at 2.5% or 3%, you're going to be financing at 7%. I mean, that's just an enormous effect. And that has many, many side effects. One of the 5 side effects it has is that new people that are coming in to buy have trouble buying because the sellers don't want to sell. You could argue that even leads to the prices staying artificially high because there's no inventory.
Mm-hmm.
But the flip side is that if it does start to break, it becomes even more brittle than it otherwise would be. The other thing is that one of the things that has historically helped the U.S. economy and contributed to the vibrancy of the U.S. economy is that people in America typically had no issue moving from Pittsburgh to Dallas, or from relocating from Seattle to Denver, something like that. And I've talked to many of my friends overseas who said that's a uniquely American phenomenon. In Germany, if you're born in Berlin, you typically stay in Berlin. If you're born in Naples, you typically stay in Naples, or Melbourne or Sydney or whatever. It's, the relocating dramatically for a job is much more an American thing than it is traditionally, other places. And I think that has contributed to the growth of America. But now, if you're locked into your house and you live in, I don't know, again, Seattle, and you see a great opportunity in Santa Fe, but selling your house in Seattle and going buying one in Santa Fe is going to cause your cost of living to more than double because of the impact, not only the tax impact of selling your house and buying a new one, but the mortgage and the refinancing. We believe it's contributing to a calcification of current inventory of housing. And so, and then when you look at the number of housing starts, and you look at the number of new home buyers and the percentage of income for new home buyers, they're all at historic streams. And so the point is again, not that this mandates a housing crash. What it's saying is the table is set that if some kind of unexpected catalyst comes along, we believe it's more fragile than some people think it is. And so those are the types of things that keep us up at night. Those are the types of things we think about. We don't really have to think about how do we make money, because we own a bunch of assets that typically go up and to the right. And if the markets continue to go up and to the right, we're going to be okay. We're going to make money. What we try to make sure is that we don't get blindsided by some kind of an unexpected rogue wave that we weren't thinking about. So it's possible that we're looking at this and we're being too overly critical, but we think we've picked up a few insights that aren't as popularly known. And so I'm happy to share the report with you, and you guys can you can take a look at it and see what you think.
Awesome, thanks. So yeah, folks, you'll be able to read this report. If you're a paying subscriber to my Substack, or obviously you could go become a subscriber to Brent's Substack, and we'll talk about that in just a second, Brent. Two very big questions that I'll just ask for your short answers on, at least this time, and maybe next time you come back on, we can talk more about this, Brent. So yeah, we were talking earlier about, hey, could the cavalry arrive in time in terms of Trump's policies really beginning to, accelerate economic growth? And you gave a good answer to that. But obviously, this would potentially throw a wrench, probably a fairly large wrench, into it if the housing market were to break down in this potential way, correct?
Yeah, I mean, I think there's a lot of different potential catalysts out there that could cause some fracturing of different parts of the market, and I don't think people are positioned in any way defensively should that happen. And again, so that's what we're always trying to look at, like what could go wrong. How could we, first of all, how could we be wrong? What could go wrong? What would happen if things did go wrong? And what are the knock-on effects? And so, you know the struggle for me is that I am kind of medium term bullish and optimistic on where the U.S. is headed. But I look at the way the table is set and I say, you kind of got to be careful right here. You can't get too overly zealous right here, because every time the table has looked like this in the past, it has typically led to some spilled milk. And that's not a pun related to the milkshake theory, but I'm just saying that typically happens.
Yeah, spilled milk, not spilled milkshake. Okay,
Yeah, right.
and so I appreciate that. Short-term cautious, medium-term optimistic.
Yeah.
Long-term, I'm curious, with a question mark, just because you mentioned the term fourth turning earlier, and I'll let you clarify that in just a second. But let me just put up this visual, Brent. This is the other question, and we could talk about this for hours. So just give me just your highest level reaction to it. But you probably saw this chart that was making its way across the internet earlier this week. This is the estimated percent of 30-year-olds who are both married and homeowners. And you can see how this has just plummeted over the past 75 years. So in 1950, it was over 50%. Here in the mid 2020s, we're down, what, 13%, maybe?
Yeah.
So really is emblematic of the challenge facing younger generations these days, where it's just so much harder to form families and form capital. So societally, when you look at that, what do you think?
I mean, it's concerning. It's very concerning, and I don't quite know how this gets solved, right? I mean, for that to change at all, housing prices need to come down, in my mind, right? But housing prices coming down tends to cause a bunch of problems. You don't, you get into this catch-22, right? I should say it's not impossible. Perhaps we're on the age of some great innovation and the growth is going to be much higher than any of us expect, and jobs are going to be plentiful, and we can grow it. Perhaps that's the case. I don't tend to think so, but I have to be open to that possibility. But I think we have to get into a situation, or we have to come up with some solution where the people that are both married and have a home doesn't continue to fall down into the right. I will say, and I listen, I don't have any data to back this up. I'm really just drawing on my own experience and those of my friends and the people I've talked to, is that I think part of the reason that chart probably down and to the right is that I kind of feel like men are a little bit different than women, and that men kind of want to get financially stable before they get married, right? And perhaps part of that is having the ability to buy a house, which you can then have your family in. And if you can't afford, if men cannot afford to buy a house because housing, for all the reasons we've discussed, and housing's up and to the right, and interest rates are now at 7%, it's not surprising to me that they don't also want to get married, right? And so perhaps that's contributing to both the non-married and no house. But
I'm sure it is. And women, and
the
we're painting
bottom
with a broad
line,
brush. Yeah, go
yeah,
ahead.
I mean the bottom line is it's a problem, and I'm not smart enough to know how to fix it, other than housing prices can't continue to rise at that same level and hope that that's going to be solved.
Yeah, and this kind of goes to where I was asking about kind of your long term is, where do you put sort of the fourth turning transition on your short, medium, long? Is that more in the long, and is that more still of a question mark, or what?
Well, so this has changed a little bit over the last 4 or 5 years. And I'll tell you, you're probably not going to like my answer, but
Oh, I don't have an
I'm
opinion.
I'm 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 coming more to the conclusion that the first turning, when we finally get to it, may be an American empire as opposed to an American republic. I think we're going through the fall of the republic now. And I think you can see that in certain policies and in certain, attitudes and in certain, allegiances. But what I'm having a hard time figuring out how the United States loses and someone else takes over, right?
Mm-hmm.
And I think for all the reasons you and I have discussed many times, and we've touched on many of them today, is that if there is some kind of great, volatility over the next 4 or 5 years, it's not that I don't think the U.S. would get hurt in that event. I think that they probably would. But on a relative basis, I have a hard time seeing how they get hurt more than everybody else.
Right, right. And that's very consistent with your dollar
right.
milkshake theory in general.
And so what comes next, I have a hard time seeing it's somebody else that's now in power. But my point is, we could have a whole 4 cycles where we go back to tradition, where things have been traditionally. Again, this whole democracy thing is so new historically, right? And it's such a short period of historical reality that it seems more likely than not that that we have a period of extended, I don't want to necessarily say control in the dark ages, but we could just have a period where we don't have as much freedom. I mean, we could have 100 years where we don't have as much freedom as we had for the last 100 years, right? I don't think, and so it's possible we could go through four more stages. The fall, the summer, the fall, and the disaster, where the U.S. is still the global hegemon. But it's a different type, and it's a different entity, or a different type of entity.
Yeah, well, it sounds like, from what I'm gathering from what you're saying, it is perhaps ruled with a more iron fist, or a tighter grip. It's a fascinating line of thinking to introduce right at the very end of this conversation. So I'm going to use that as a really good impetus to reach out to Michael Every and maybe pick up on that when we get you and him on here together at some point in the future. Brent, I want to thank you for today in general, but also for being willing to come back as faculty for Thoughtful Money's fall online conference. Folks, I've been telling you that we're about to start kicking off the marketing and sales for that. I'm just about there. So if you want to go, tickets are actually available now. You can go get them at thoughtfulmoney.com/conference. If you are a paying subscriber to our Substack, wait until you get the email from me that has that announces the conference and has your promo code, because you can use that to get $50 off our early bird price. But the early bird price is available right now for anybody at that thoughtfulmoney.com/conference URL. But anyways, Brent, really excited to have you there. The faculty this year is going to be amazing. Lacey Hunt, James Grant, Judy Shelton, Stephanie Pomboy, Grant Williams, a whole bunch of others. But anyways, it's going to be a great time, and I'm so glad to have you there again. For folks that would love to follow you and your work between now and then, where should they go?
Well, you can follow me on Twitter. I'm very active there. If you look up Santiago Capital, it's the seashell. Santiago AU Fund is the handle. You can also find our work at research.santiagocapital.com. There's a couple different levels that we provide there, and that is really focused on the intersection of geopolitics, financial markets, and the madness of crowds. We have tended to write more about big picture issues and geopolitical issues and more non-specific finance related stuff over the last year, but mainly because we feel like that is the stuff that is driving markets as opposed to earnings announcements and balance sheets. But we think the intersection of those three things is really fascinating. And so if you like what we've talked about today, and if that sounds of interest to you, we'd love to have you as subscribers on our platform.
All right, fantastic. And Brent, when I edit this, I'll put up the URLs there so folks know where to go. Folks, the links will be in the description below the video as well. Brent, it's always such a joy, buddy. Thanks so much for coming on.
Thanks for having me.
All right, well, now's the time of the channel where we bring in the lead partners from New Harbor Financial, one of the endorsed advisory firms by Thoughtful Money. I'm joined as usual by lead partners John Lodra and Mike Preston. Boys, great to see you again. Thanks so much for joining me. Mike, why don't we start with you? What were some of your key takeaways from this discussion with Brent?
Hey Adam, that was a great talk with Brent Johnson. Thank you. I've got a bunch of notes. I'd like to hit some of the highlights that I wrote down. Brent has been a dollar bull for a long time, and hence his dollar milkshake theory. And he said that he thinks the dollar is oversold here. I'm looking at the DXY index. It's right around 98. It probably is getting a little bit oversold. It's been in a long-term downtrend. We think that support is maybe down in the 95 area. So really, we don't want to second guess when that turn is gonna happen. We think that it could have some further downside, and it's been very supportive of some of our positions, like precious metals, like emerging market bonds that are denominated in local currency. So, yeah, I don't know that we completely agree that it's oversold. We think it's got some more downside, but when and if we do get a market peak and a drop, we think there will be a move towards safety, and then the dollar will likely catch a bid. Yeah, yeah. Brent talked a little bit about the fact that he expects volatility to pick up again. VIX is indeed down at around 14. It can go lower and probably will if this market continues higher. We just don't know what's going to happen near term. I think that we'll talk a little bit more about our indicator dashboard, how we've seen some very early warning signs, not great timing indicators, but if some of those actually come to fruition and we see a bigger pullback like Brent says he expects perhaps in September, we'll start to see VIX shoot up. But in the near term, it could trend down for quite a few more weeks or even longer. As I just said, Brent says that he thinks we'll get some kind of correction by the end of September. Not 100% sure that we agree with that either. We're not going to second guess it. We're going to follow our indicators. But some of the things that he surmised could cause it is perhaps a Fed pivot. And the Fed is nearly 100% likely to cut rates in the September meeting. And the market likes to front run, and the market likes to look forward. And oftentimes a recession starts right at the same time the Fed pivots for the first time, like you mentioned, I think, Adam. And don't forget that the yield curve has been uninverted for a while after being inverted for the longest time in decades, and that too portends negativity in the market and in the economy. It just hasn't mattered yet. What's really different about this time we're living through is that nothing's mattered for longer than it's not mattered before. And we don't think that is going to stick forever, nor does Brent. And we're all having a hard time putting our finger on when it's going to matter. But valuations are triple what they should be long term. VIX is low and could expand. And all we're really looking for or waiting for is some kind of catalyst. We're all it's a difficult game because we're all forced to try to guess. We don't really have to guess. What we've done at New Harbor is we've got a conservative position. I would say that we're underweight equities, and we have been for a while. And we've tightened up some hedges that we'll talk about in just a minute. So just to kind of finish up here, Brent expects that for the next 4 to 5 years, he prefers U.S. equities. We probably disagree a little bit there. We see some outperformance in foreign equities, and we have a big chunk in foreign equities, and we might expect them to outperform as well in the next couple of years. And lastly, in the market, we're starting to see some things, some differences. We're seeing the same sectors continue to outperform. He didn't really mention sectors, but things like utilities, industrials, financials, technology, we've been in them for months and they continue to be the best sectors. And we're just starting to see some early signs, perhaps, of a broadening out to other things like the Russell 2000 and the S&P equal weight, although it's very early for that. So I feel like I should take a pause because there's even more I could talk about, and there's probably too much even there. But good talk, and thank you.
Thanks. Well, I see you guys and Brent is similar in terms of looking at the current valuations and being very skeptical of them. Yet it is the markets we have, right? And so to a certain extent, as a capital manager, you got to trade the markets you have. Brent is deciding to do it by keeping his existing allocations, but adding more hedges. He mentioned, as several have mentioned of late on this program, that puts, especially like on the S&P, are quite cheap right now. Are you guys availing yourself of that that inexpensive downside protection right now? In other words, are you guys well, explain what you're doing with your hedges. Are you adding them because, are you adding to them? And if you are you adding them because you're concerned about valuations? Are you adding them because, gosh, it's just so cheap? Having this additional protection, just makes sense when it's this cheap.
Yeah, look, let me bring up a chart to explain that, Adam. This is going to be a chart of the daily chart of the S&P 500. We had some index puts going into this April drop. This is right after Liberation Day. And then we covered them right around here a couple weeks after the bottom. I'm not going to say we nailed the bottom. I wish we did. But we did cover them on the rebound. So we took a nice profit on those hedges. And we have not had hedges in place up until last week. Last week, we came down. We went through the 21-day moving average. If you take a look at the S&P 500, it's respected this 21-day moving average pretty well, including with this last pullback. But on this pullback, a lot of our short-term indicators, or at least some of our short-term indicators, went from neutral to warning. And because of that, we reestablished index puts. Now we've got around a 45% equity exposure, and we added a 15% notional put option, September 59.50, right down here where this line is. So, and that's also the last swing low back here. So it would take quite a crash to get down there. But if that were to happen, it would immediately reduce us from about 45% to 35% equity. So that would be a first step. And we probably disagree a little bit with Brent in that Brent would like to increase equity if we get that type of pullback. We would actually like to decrease equity if we get a pretty big pullback because we're not really expecting another V-shaped bounce. So in other words, our puts would drop us to 30%. And if we kept going down, we would then start taking some stops in our sectors and reduce theoretically even more. So I could say we definitely probably disagree on how we would respond to a drop. Details matter. We'd have to see everything else that's happening, including our indicators. But we did reestablish that put. Maybe it was early, who knows. But if we keep moving higher in the market, we will raise that floor and start following the market up with that. And so we will see.
Okay. All right. Well, John, let's flip over to you here. Feel free to add anything that Mike just said about the Brent discussion, but would love to hear about the indicators that you guys are looking at New Harbor. And I think I might have heard you mention before we turn the camera on here that you're starting to perhaps see some erosion in them.
Yeah, good to be with you, Adam. Thank you. And I always enjoy Brent's comments. He's got a good big picture view that we very much appreciate. Yeah, just to dive a little deeper. So the last several weeks, so Mike already talked about how, not dissimilar to Brent, we had lots of reasons. Valuations have been an ever-present reason to be concerned, but they are very poor short-term timing indicators. And we all know that painfully all too well. Bubbles can get bigger yet even than your worst imagination. So we look at a lot of other things beyond valuations. Now, certainly we've been underweight. If we were at a third of the valuations right now, we might be more comfortable being 70, 80% in equities than, for example, the 45% that we have our clients in on average. But we look at other indicators, things like breadth and participation and momentum. And those very much were pointing to negative market action in the first part of the year. And that's one of the main reasons that we, not only because of valuations, but some of these participation indicators are really kind of weak. And so suggesting that we had much downside potential. And that's certainly what played out. And coming out of the lows in April, that has completely flipped. We've seen, until recently, we saw that those breadth indicators very strongly across the board, suggesting a very, very wide participation rally, especially coming from the really washed out levels that they achieved in April. But in just the last couple of weeks, we've seen some of those things turn down. We look at things like, and I don't want to get too techno babble here, but there are things like bullish percents that are measure the percent of stocks within a given universe, be it the S&P 500 or the broad NYSE or whatever, that are on buy signals, price buy signals, right? These are one measure of participation. There's also, you can look at the percent of stocks registering above certain different moving averages. And those have more or less uniformly started to tire and turn down, not in any kind of shockingly concerning way, but enough to tighten up some hedges. And Mike mentioned we put some out of the money put options on, but we also did sell some call options. So net, we've taken in more premium on selling call options than we outlaid for those put options. And I would describe this as not a dramatic change to our positioning, but one that is incrementally appropriate for what we've seen in the erosion. And we'll take further action if we see follow through in some of these indicators to the downside. And one point I want to just emphasize with hedging, one should not think of hedging as a profit center any more than one thinks about insurance on their house or their car or even their life as a profit center. It's a good thing when you don't need the insurance, right? It's great to get it for free or not have to pay for it or offset the cost of that by selling call options and bringing in premium. But we're perfectly happy having those puts and them not being needed. So yeah, it's a great thing that the cost right now is cheap, but more importantly than the cost being cheap is there was good technical information, data-driven information to be somewhat more defensive. We did. I want to just echo what Brent said. We have seen a notable shift in momentum. I'll just show you a quick chart because I think it's sometimes helpful to look at little pictures here. All this is momentum in its various forms just measures a shorter term moving average relative to a longer term moving average. And as Brent rightly pointed out, oftentimes when you get a crossover, and especially when prices are diverging, when prices are going high but momentum turns down, that oftentimes results in price following suit. And what we've seen here, we saw, for 14 weeks, the weekly momentum on the S&P positive, and that's essentially this blue, bubble above this horizontal line. Just recently, that turned negative. That's a fairly long period for the S&P to have positive momentum. Rarely does it get that positive for that long. And it's just one of many indicators that suggest a weakening, a tiring. Mike suggested we're starting to see a little bit of perking up in some of the mid cap and small cap space. And that's just something, frankly, that's just recently, in the last couple of days. And I think a big part of that might be very much the interest rate situation. There has been a very dramatic repricing by the market, perhaps coming out of the jobs report that was revised a couple weeks ago, and then the inflation report. Frankly, I think the market has maybe gotten a little exuberant. But this is this is right off what's called the CME FedWatch tool, and it shows the current. This is for the September Fed meeting. Right now, the market is pricing in a 99.95% probability of a cut from the current 4.25 to 4. You don't get much more certain by the market than that. And if I had to say one thing, there's not too much in life that anybody can fairly call with 100% probability. If
Right.
there's a surprise coming out of this, it's probably that the market has gotten too bought into the idea of a rate cut. Not to say it won't happen, but dramatic change. Just look at a month ago, there was only about a 61% chance right there. Actually, 57% chance. And then if you look at a different view on this right now, again, I guess it's changed a little bit today. It was 99.95 earlier today. But the market's now pricing in a base scenario by these blue boxes of 3 cuts by the end of the year. That was up from just 2 cuts. This is having, I think, a reverberation through a lot of different asset classes. Small caps tend to be much more interest rate sensitive because their debt is oftentimes floating rate debt. So a perceived reprieve in short-term rates is usually a sign of relief from a debt service standpoint for these companies. And we all know about the often talked about high percentage of Russell 2000 stocks, for example, that are losing money, and any kind of relief is a welcome thing. But the weakness in the dollar, we have seen a resumption of a generally trending down dollar. That's hand in hand with lower interest rate expectations. So pretty big moves here in that I think are having some short-term impacts on markets. But we're happy to be in the position the way we are and happy to have incrementally tightened up some defenses, but still very much we're in the sectors that are showing persistent strength relative to others. We're not really in healthcare or energy, for example, which have been pretty much all year long very much laggards, even though they, from a fundamental standpoint, might have some redeeming takes on them. And then, as Mike has talked about, we're seeing some very sustained strength in the international space, both stocks and bonds. And a big part of that, no doubt, is because of the weakened dollar.
Okay. So beyond the new hedges that Mike just walked us through, are you pretty much just riding what you have right now then?
That's pretty much right. Yeah, we we work really hard to justify making changes. We're not in the business of just doing things for the sake of doing things, and it's knock on wood, it's working out pretty good. We've had good solid results for clients year to date with not a lot of volatility, and we just look forward and we let our data kind of guide us as to what maybe the next tweak or big tweak in portfolios might be.
Okay, good. So as far as you guys are going, it's steady as she goes. You're happy with the plan you have in place. And I always dig about whether you've made portfolio changes because I know you don't make them lightly. And so when you do, I want to make sure we let the audience know. All right, Mike, why don't we come back to you for just a quick little wrap up. Tell us what's going on with gold and silver. I know there's been some volatility there over the past month, but despite it all, they're still kind of hanging in pretty well, correct?
Yeah, gold and silver have been really steady performers all year and even last year. We feel really grateful to have the wind at our back for the first time in quite a while after many years of miners and metals being underperformers. But right now, miners are outperforming bullion. And then within bullion, silver is outperforming gold. So a good chunk of our performance year to date, I can say, is because of miners and bullion. And silver, as you said, has had some volatility, and so has gold. Let me just bring up a chart of an ETF that follows gold and silver. We can take a quick look at it, and that's coming up right now. So the first one's going to be a daily chart of gold. Take a look at this as it comes up. Gold has essentially gone nowhere since April. This is where my arrow is here is April 15th. And here we are now. We had this nice triangle, but then it just kind of petered out and it's been walking along this 50-day moving average. It hasn't done anything bad technically, hasn't violated any levels, and we've just settled into this 33 to 3400 range for gold. Silver has been a little bit different. If you take a look at silver, silver actually has over the same period of time, I'm going to pop that symbol in now, over the same period of time, it's actually gone up after it had that triple top breakout that we kept talking about. This level is 35. And so if you go back to April, you can see that silver's gone up since April while gold has gone sideways. And yet the ratio of gold to silver went from about 104 to 1 to about 86 to 1. So silver actually looks really good here. Take a look at what happened a couple weeks ago. Silver went to about 39.50 on spot. This is an ETF, so it doesn't show spot, but we went to about 39.50 and fell like $3 and then bounced perfectly off the 50-day moving average. and silver's up 1.5% today, and it's back to threatening pretty soon, I hope. It's all-time high. It's right in that neighborhood. And meanwhile, the miners just continue to perform. Take a look at the junior miners. They broke out recently, even with gold going sideways. GDXJ is up there at 73. GDX, kind of like the flagship mining ETF, is up at 58. Take a look at the weekly chart. We've got a big solid breakout, and it's going higher even with gold going sideways. So that's the big picture on gold and silver. Right now gold has gone sideways since April. What happens to miners if gold breaks out of that range and takes off? I think miners will play some more catch up. We've seen some really good earnings reports out of miners across the board. AEM, Agnico Eagle, Newmont Mine, a lot of these different guys have reported. Franco-Nevada just reported good numbers. And so it's looking really good in that space. But again, it's miners over bullion and silver over gold. So don't be over allocated. Don't bet the farm, but have a nice allocation there. 5 to 10% on bullion is what we recommend. And we think there's some legs left in this move.
Okay. Well, I mean, having talked with you guys every week for years, I feel like this script is playing out the way that you thought it would, right? Which is that gold tends to move first, then the mining complex and silver follow. That's exactly what you just walked us through there, Mike. And the miners tend to start having their day in the sun when the earnings beats come in, right? Where it's such a hated sector in general, given its past performance, it has to kind of over demonstrate the fact that it's being nicely profitable. And I think one of the potential shoes to still drop that's out there that I think you've mentioned, Mike, is when there's the party is still raging in the sexy stocks, like the AI stocks and whatnot. Wall Street's going to remain enamored with them. But if the general market starts to cool off and Wall Street starts looking around for, okay, well, where's the next momentum for me to move into? It very well may likely start looking at the precious metals complex and saying, wow, that's great, phenomenal profit and cash flow growth. I want to get me some of that. And because it's a small market, won't take a lot of market cap coming from the Mag 7 into that space to really send prices higher still, correct?
No, it won't take much at all. In fact, I think it's only Newmont that's in the S&P 500. So fund managers, if they're going to buy an S&P 500 company, have to buy Newmont. So it's not going to take a lot to really create an outsized move. Now, let me be clear. We've already had a big move in miners. So it's not early in the game. It's just that we think that if gold breaks out of those levels that I demonstrated going back to April, that we probably see a little bit of euphoria in the miners. And so you want to have something on board for that. We don't know what the next big rotation is going to be. It might be into miners. It might be into the lagging sectors like healthcare and biotech. Who knows? But as I stated earlier, the same sectors have been outperforming for quite a while. The sectors that I mentioned, and even gold, silver, and miners have been outperforming all year and even longer. And so one thing I've learned is that it's really hard to predict the top in any market or any sector. And so if these things start moving, it's going to be good to have a piece there. We'll start adding some hedges if that happens, but we hope to get to take some of that ride.
All right.
And
All right.
Adam, I'll point out that we actually have sold some call options on half our minor position. Very short term dated calls. Took in some premium because things got a little extended on the short term. But what that allows us to do is, if we do get a breakout to the upside again, we can roll those calls out, buy them back. There's a lot of things we can do to kind of participate if we get a renewed spike higher. I just want to kind of give a nod to your talk about the meme stocks kind of, kind of maybe running out of steam. It's probably ironic that today we have a high profile IPO in a company whose name is none other than Bullish. It's a crypto exchange company IPO today. It's already up over 100% on the day. So, these are the kinds of things. I know nothing about this. I guess it's a crypto exchange that is catering towards institutional players. So arguably a more sophisticated and stable, kind of, but to call oneself bullish, literally the company Bullish is these things write themselves. And we also have another company, CoreWeave, which is, kind of thrown into the same bathtub, if you will, with NVIDIA. They came out and are off pretty good. They had positive guidance in earnings, but their losses were quite a bit larger than the market expected, and we're coming upon a lockup. So we're starting to see some of these kind of meme stocks either kind of go to the moon or start to tire, and it just these are the things you can't take in isolation, but they are kinds of things you see at a turning point in markets.
They tend to be sort of late stage in the exuberance. Yeah.
Yep.
All right, John. Well, look, gentlemen, thanks so much. We're going to have to close it up here. It's been another great week. I guess real quick, just before we go, John, 30 seconds. Anything that you guys are hearing or noticing from your conversations with just everyday investors in terms of the mindset of the average investor right now?
Well, I think we've seen some people try to focus on having some summer, which is always good.
That's healthy.
We've heard from many of our clients that they're happy that we're looking after things day to day, so they can enjoy a little time away. But look, I think people are looking at these markets. They're looking at the headlines, the tariffs, the rate job owning, and they're confused, right? It's a confusing time. Nothing seems to make sense other than things just keep going up. At least that's perception. And that's why we really want to illuminate for our clients and folks that we talk to through your channel and otherwise, that there's some texture that you got to be really tuned into here. That it's not just what's the S&P doing on a daily basis. There's more to that. But generally speaking, I think people are kind of tuned out, maybe trying to get some mental relief from what otherwise has been a head spinner of an environment.
Well, look, I definitely endorse getting out, clearing your head. I myself just took a vacation last week. It's very important to do. That being said, I think you want to return, with a good plan in place, especially for a market that might have the volatility ahead of it that Brent thinks could happen here. So my general advice to folks would be make the most of the rest of your summer, but maybe schedule a time upon your return with your financial advisor to just get things in order, make sure that you've got a good sense what the game plan is, especially if we get the correction that Brent thinks could happen potentially as soon as September. And just make sure that you're starting the rest of your year from a foundation of confidence, right?
Yeah. Adam,
so,
I'll just throw in, we're not big fans of like these seasonality kind of patterns, mostly because they basically they rely on averages, and you lose a lot of information when you just look at averages. That being said, there is that added element that we just entered the seasonally weak period. Typically, the year after an election, this like almost to today starts a seasonally weak period in the latter part of August into the fall. Again, nothing in there in itself is a prediction, but you throw that in, with some of the other things. It just, I think, beckons a good deserving, kind of look to tighten down. Make sure you're not taking more risk than you really want to or can afford to. And so it's always a fresh time to take a look at those kinds of things.
Yeah, I'm glad you mentioned that because it's like a layered approach, right? You can say, well, look, this is sort of the seasonally dangerous time of the year. Presidential cycles, year one, tends to be the worst year of the four. Okay, macro-wise, economy seems to be slowing. We're seeing some cracks here. Stock valuation-wise, okay, stocks are very richly valued, at valuation extremes right now. And then to your point, John, the actual indicators you look at, you said just sort of tipped from mixed to increasingly, worried, right? So like when you layer all that stuff on there and it all is basically saying, hey, this is probably a time for caution. Collectively, it tells you something important, right? Maybe individually, each point you don't want to hang your hat on, but collectively, it starts to speak with a real volume.
That's right.
So anyways.
We think of things as weight of the evidence. That's really the way one should treat these things. The weight of the evidence. No one indicator, no one data point is reliably and consistently this kind of light switch indicator, but it's the confluence of these things together that can oftentimes paint a picture of useful perspective.
Thank you. Very well said. So folks, bottom line being, if you are hopefully taking some time to enjoy your summer, make sure you come back and get a good plan in place. If you've got a good financial advisor who is helping you navigate through all this and executing the plan for you, fantastic. Don't mess with success. But if you don't have one doing that for you, or you'd like a second opinion from a good one, highly recommend that most of the people watching this video consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. Perhaps you'd like to even talk to John and Mike themselves and their team there at New Harbor. So to set up one of those consultations, just fill out the very short form at thoughtfulmoney.com. These consultations are totally free. It only takes you a couple seconds to fill out the form to request one. There's no commitments expected or involved. It's just a free service these firms offer to help as many people as they can. Folks, if you really enjoyed having Brent on this channel, would like to see him come back on again soon, especially for that joint session with Michael Every that I proposed, please let us know that by hitting the like button and then clicking the subscribe button below, as well as that little bell icon right next to it. John and Mike, thanks again for another great weekly wrap-up, good to be back in the saddle with you after the week off. You guys look good and rested, so it looks like you're enjoying your summers as well. Thanks again for doing such a great job. Look forward to having you guys make sense of the action that happens next week for this audience when you guys come on a week from now.
Thank you, Adam. We really appreciate it. See you soon.
Thanks again, Alan. Adam, we'll see you next week.
All right, and everybody else, thanks so much for watching.